Welcome, everyone, to the Daniel Krug and Associates Wealth Management Review for July 9th, 2020. Today's presentation is titled Managing COVID Uncertainty. My name is Rocky Isfan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. A reminder, this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have any questions, please just call the office and we will help you with those strategies. We're looking at about a 30-minute presentation today. The session will be recorded. Everyone will be muted. However, you can use the chat room for questions or just to say hi. We want to thank City National Rockdale for their contribution. Well, let's move on. I'm going to hop on the screen here now for a minute to say hi to everybody. Good to see everybody on board. Today's agenda is we're going to be going over what is wealth management, the major developments that have taken place this week, a COVID-19 update, reopening and unemployment, the markets and investing, and then if you guys have typed any questions in, we will address those at the end. So just a reminder on what wealth management means to us. There's basically 5 different categories that we work on at Daniel Krug and Associates, beginning with the investment strategy. Now, most firms do create an investment plan for their clients. However, some do it better than others. But where we really differentiate ourselves is in the advanced planning area, which is wealth enhancement, wealth transfer, wealth protection strategies, and about a third of our clients are charitably inclined. So we have developed many different charitable giving strategies that work quite well for our clients. So let's move on to the major developments that have taken place this week. The new infection case counts are rising in the southern and western states. However, they're falling or flat in the East and Midwest. So we're going to touch on that a little bit, some of the data. A significant part of the reported increase in cases can be attributed to the increase in testing. And we're going to show you how that's gone up in the last week or two. New cases in New York have fallen off so much that someone appears to have turned off the hose. They've really done a great job on mitigating the spread of the virus there. And they're no longer the headline. It has moved to the southwest states and California. So another thing, I think the debate is over regarding what works and what doesn't work. So the things that have proven to make a substantial difference in reducing the transmission are social distancing and wearing a mask. And we're seeing them starting to implement that a little bit more vigorously out west. Younger patients and better treatment approaches keep present data on facilities on a downward trend. So we've seen that we've learned how better to treat people once they are hospitalized, and that's proven to reduce fatalities. New infections in Europe remain well controlled and very low, along with Asia. So let's go on and talk a little bit about COVID and some of the numbers. So what we're seeing in US cases, hospitalization versus fatalities. If you look at the graph, the top line, the dark line is hospitalizations, and that was coming down significantly, but has started trending up the last 2 to 3 weeks, mostly out west, like we said. Daily new cases is also on a rise. That's the blue line, which is now above the hospitalization line. And if you see at the very end, there looks like a little bit of a flattening. We'll talk about that. And then the good news in this chart is that the daily new fatalities is still continuing to drop, but this can lag hospitalizations a little bit. So let's go a little bit into more of the numbers here. Fatalities projected to increase moving forward with the increase in hospitalizations. But if you look at the dotted line versus the solid line, you can see that what's being projected over the next couple of months is a slight rise. However, nothing near what we were seeing in April. So I'm going to drop off here and keep going. Fatalities as a percent of hospitalizations. This is another good piece of information that the number of people going into the hospital and actually dying from COVID is decreasing and continuing to decrease. Early signs of slowing spread in several hotspot states. So let's talk about where the issues are at right now, and that is in Texas, California, and Arizona. And you can see Texas has had quite a good surge increase taking place in hospitalizations. That's something that we have to pay attention to. California and Arizona, however, they were increasing, but what we are seeing is a flattening of that curve and actually a little bit starting to move trend downward. So these are very positive signs moving forward, and we're expecting similar data in about a week or two in Texas, that we'll see a flattening taking place there. Again, these states have upped their distancing procedures and requirements for wearing a mask. Some of them have closed the bars and things like that down to start reducing, again, the spread of the virus. And we think that's going to be a positive trend moving forward. Good news here, testing has surpassed the initial goals. The initial recommendation was to be testing about 4 million people a week for the virus, and we've actually exceeded that in the last week or two. So we're over about 4.5 million tests being conducted weekly. And along with that, the chart on the right shows we have seen a slight increase in the positive test rates. However, it's still relatively low compared to the amount of testing that's actually taking place. So let's go on to another section here. Let's talk a little bit about the reopening and unemployment. So where are we standing in the last week or two? And this first chart is basically measuring consumers going out to dine at restaurants and things like that throughout the country. And as you can see, there's been an increase since about the middle of May. However, here in June, in the last couple of weeks, it's gotten a little bit more volatile, the willingness of people to go out. And again, that's due to the fact that we've seen a rise in Texas, Arizona, and California. So things are slowing down a little bit. However, we still see an uptrend in this and believe that there's going to be more and more people getting out and being willing, if they're following the procedures, the social distancing, wearing masks where required, things like that, that we should still see good positive response in decreasing the spread moving forward. Another area that we were looking at in the last couple of weeks is what's going on in the service industry. And this chart represents non-manufacturing purchasing managers, what they're buying. So this is the service industry purchasing managers and what they are buying to get their businesses back up and running, the materials, the supplies, things like that. And we are seeing increases in purchases for businesses to continue to operate. Even though it's not near where we want it to be, it's a much, much better than what it was. The unemployment rate. Now, just a couple months ago, the unemployment rate was about 14.7% in April, but we've seen it drop a little bit more than expected. So we are seeing some initial strong recovery in unemployment. If you notice in this chart between April and June, May is also lower. What happened is they readjusted the number for May. If you remember, we showed a chart a couple weeks ago that showed a slight increase in May. That number has been revised and brought back down. So through June, we're looking at about 11.1% unemployment, which is an improvement. However, there's still quite a few people unemployed, and we're going to talk a little bit more about that in this chart. So basically here what you're seeing is we've plotted the temporary layoffs versus the permanent job losses. And these are being tracked and again studied on an ongoing basis. So where we were seeing in April an 18 million temporary layoff situation, we're looking at about a 2 million permanent loss in the job market. Well, those numbers now through June are at 11 million temporary layoffs, and about 3 million, they're saying, is going to be permanent job loss. Where are those permanent job losses coming from? They're coming from companies that basically are not going to reopen, businesses that are reorganizing based off of needing to operate a different way in this environment and changing their jobs and employment strategies and things like that. So we do expect a little over 3 million, possibly 4 million in permanent job loss as a result of COVID. But the good news is that the layoffs are gradually slowing down. Temporaries layoffs are turning back into jobs, and people are getting hired and brought back into those positions. One of the questions we keep getting in the office is, when do we expect a full recovery? And what City National Rockdale did is project here where they think the gross domestic product path of the United States is going to be over the next couple years. So as you can see in this chart, we bottomed out in Q2 of 2020, but the path is showing getting back to the previous gross domestic product for the United States. That's all goods and services produced on an annual basis. It's going to take us till about the beginning of 2022. They're estimating somewhere between the first and second quarter that we will be back at full gross domestic product growth in the United States. So it is going to take a little bit of time for this economy to grow back. Okay, let's move on to markets and investing. So I'm getting through this pretty quick, so this is good. So we'll have time for Q&A here. But let's look at what's going on with the market. Basically, Dan and I have been showing this chart over the last couple of weeks. Stocks appear to be pretty high valued right now. In fact, a little overvalued historically. Currently, the price earnings ratio for the S&P is at a little over 22. History has shown us it's been around 16 for a historical average. So we are definitely overvalued. But keep in mind that this is also during a time that we are at historic low interest rates. So what we're showing here is that for the last 40 years, interest rates were declining and settling around 2%, but the Fed came out and dropped interest rates due to the COVID situation. They dropped them to zero, and they're saying that they're going to keep those at zero for a couple of years. So in light of what you can get in a fixed income or bond type of yield versus the stock market, it may make sense that the stock market is a little bit overvalued right now in this current interest rate environment. So what can we expect moving forward? We're looking at more moderate rates of return out of portfolios. So low interest rates and high stock valuations basically equate to lower returns in the future. And investors should consider opportunities to look at how to adjust their portfolio to continue meeting their goals. Looking at this chart, we're basically saying that if you looked at history from 1975 through 2019, the stock market had returned an average of 12%. Now that's a gross number. That is no fees, no trade costs, no nothing. That's just a pure number for the S&P. And the bonds during that same period from 1975 to 2019 returned about an 8% gross rate of return. So a blended portfolio of 60% stock, 40% bond would have yielded a gross 10% annualized rate of return. And a 70-30 blend would be about 1% higher. So what you're seeing here is basically gross numbers. So you got to figure on average after fees and expenses, you're about 2% below that. The next column talks about just the last 10 years from 2009 through 2019. What you saw was a little shift in U.S. stocks, gross return of about 14%, so a little higher, but bonds down about 2%, so they were lower. It still yielded the 10% annualized rate of return gross in a 60-40 portfolio and 11% in the 70-30. However, the shift also added more risk to the portfolio because you were increasing your stock position because it was growing faster than in the past. What we're forecasting moving forward and what we're looking for over at least the next couple of years is about a 7% gross rate of return out of U.S. equities. However, the bond rates, due to interest rates falling and being set by the Fed at zero, we're only expecting about a gross 2% rate of return out of the bonds portfolio. So when you have a blended portfolio, the traditional 60-40 is going to look at about a 5% gross rate of return, 70-30 portfolio about 6%. So significantly less. So what we need to do is adjust some of our expectations or look at different ways to manage the portfolio moving forward. So some of the investment considerations that we are looking at Daniel Krug and Associates and considering as we're planning and doing asset allocation is we believe the recession is over and the recovery is well entrenched to continue. We are on a growth path. Okay, however, it will be slower than in the past. New times require new thinking for strategic asset allocation. Things are different. In a zero interest rate environment, you have to look for other opportunities to bolster that portfolio and help you carry it through to reach your long-term goals. Equity markets are likely to be higher a year from now, okay? Modestly higher. But what we have to remember is that there's going to be volatility, okay? It would not surprise us to have one or two 20-plus corrections to the downside in the market over the next year. So we have to pay attention. We have to make sure that we're properly asset allocated and that we are invested for the long term moving forward. Yields are going to continue to stay low for at least 2 years as the recovery takes until at least the end of 2021. Again, we got to stay focused. What are the goals and what's the plan to get there? Governments in the United States, Europe, and Asia are fully committed to putting money into economies to sustain recovery. That's been very evident, and that's one of the reasons that we're in the shape we are right now and why the stock market is performing the way it is and the bond market is holding during this time because the Fed has got involved. Fiscal policy and monetary policy have been very, very proactive during this time period. A couple of the places that we're looking to increase the performance of the portfolio is in high dividend stocks and high yield bonds. So they are attractive. We don't want to get over balanced with those, but they need to be considered as essential in the portfolio moving forward. So what can you do in this world of moderate returns? Well, you can evaluate your spending plans, distinguish between needs and wants. What does the next couple of years look for you from a spending perspective? Are there some ways that you can make adjustments? Okay, so we believe the portfolios are going to give us a return, but it's going to take a little bit longer to make those average numbers because of expected volatility over the next year or two. Can I adopt a variable spending plan? Are there things that are in your budget that maybe You don't have to do every year. You could do it every other year. What kind of discretionary things are going on that you can spread that out a little bit? The next area is assess the risk preference of your investment strategy. Look at opportunities to enhance your performance of your portfolio on money that is not needed for the next 10 or more years. Can we be a little bit more aggressive, understanding that things are going to be volatile, but what can we do with long-term money to up the average rate of return? And then the final thing is, how do we optimize the portfolio? Okay, there's opportunities in less liquid, higher returning investments. Again, those would have to be used for long-term portfolios, 10 plus years. But that's another way to bring some of these things in that maybe aren't in a traditional portfolio to help boost performance over time during these low interest rate times we're in. So to give you an example of what I'm talking about, we've created an example of a couple that's, let's say, about 5 years out from retirement. And looking at the two pie charts, you see the traditional approach. And what the traditional approach of a 60-40 portfolio has been to use 60% of the portfolios in U.S. large cap stocks, pretty much core stocks, your large cap, high dividend paying companies, versus investment grade bonds at about 40%, which are your safe, more secure, high rated bonds. Now, if we compare that portfolio to an optimized portfolio, again, what are we trying to do? We're trying to look for places that we can interject a little bit more performance into the portfolio over the next 5 to 10 years. That portfolio would be more of a 45% large cap stocks, focusing a little bit more on high dividend stocks, not necessarily large cap, but companies that are paying high dividends, and adding a little bit of emerging markets, which tend to be more volatile, but have provided a higher average rate of return over the last 20 years versus the US market. Those are new opportunities that are out there, and having a little bit of that in the portfolio can, over the long haul, give you a little higher rate of return. Opportunistic income. So it's looking for other things besides investment grade bonds. And that's where we were talking about high yield bonds. Now, the credit rating isn't quite as good, but if you get a good blend of those type of bonds to spread your risk among many companies, which our money managers do a great job of doing, that's another place to look at. High yield bonds along with investment grade bonds. And then finally, about 15% in alternative type investments. What are alternatives? Alternatives are things like private equity. We've got some great money managers that manage private equity portfolios. These are companies that are not traded on the exchanges. So how do I get into that company before it becomes a publicly traded company? There's these opportunities out there, and we have ways to take advantage of them. Commodities is another area that we look at as an alternative investment strategy. Real estate. There's many things out there that are not traditional stock and bonds that we can incorporate into the portfolio for long-term value in generating the returns that you need. So these are the things we want to look at. Now let's look at the boxes which show how the two different portfolios may work over a 5-year period. And again, data constructed by City National Rockdale for forecasting, where they're doing the research on this. So let's take a $2 million portfolio, that's the box on the top left, and compare it, what happens over 5 years, and how much income we can expect off of that portfolio in retirement, comparing the $2 million portfolio against the traditional and the optimized. So when you're looking at this chart, the 5-year projection shows a traditional portfolio would grow from 2 million to $2.5 million. I'm in the middle column right now. So a traditional stock and bond portfolio in this low interest rate environment would grow about $520,000 over 5 years, from 2 million to 2.5. In retirement, we could expect in a traditional portfolio to generate about $42,800 a year, and that income be sustainable throughout an average lifespan. Now we compare that over to the optimized portfolio, which is the pie on the right, where we've brought in the other investment strategies and integrated those in. The 5-year projection in that portfolio would be a growth up to $2.76 million. So $760,000 generated over 5 years on that original $2 million investment. However, the sustainable retirement income for that portfolio throughout retirement would be $61,800. And you might be saying, wow, that's a big jump from $42,000 in a traditional portfolio to $61,800. It is, but where is some of that increase coming from? The fact that the optimized portfolio continues to generate a 1 to 2% higher net rate of return to the investor throughout retirement. So you have more money available to take as income over the same time frame. So I hope you can follow that, the difference between the traditional 60-40 and optimized portfolio, where we are increasing the risk a little bit. If you go back to the pie charts, the equities in the optimized is 67%, okay? So it was 60 in the traditional. So you have increased your equity exposure by 7%. You've also increased a little bit of risk with lower rated bonds, high yield bonds in versus the investment grade bond portfolio. But alternatives can be fairly neutral. So we basically went from a 60-40 equity bond blend to a 67-33. Okay, so I hope this was helpful for you guys to see that. We believe that moving forward, we're still moving in the right direction. However, we have seen some signs of weakness, like we talked about with what's going on in Arizona and Texas, and how they've had to slow down their reopening. So that's going to put a pause on some things. It's going to make other states look at what they're doing and should they slow down their reopening, so on and so forth. So we are going to see how that all shakes out. But we believe we're on a path to move forward. We believe we've resolved some of the questions early on what really allows us to reopen, considering things like the social distancing. Should we wear a mask? Should we not wear a mask? Things like that. So again, hope this was helpful. If you guys have any questions, let me pop myself back up here so you can see me. I am here still presenting to you guys. Let's see, on the questions side, no big questions going on. So that's good news. What you guys are telling me is that you understood it, that I made sense. So I appreciate that. I appreciate you guys being on today's presentation. So there's no need for you to worry. You take care of your family, and we will take care of you guys. If you have any questions, give us a call in the office. Anything you want to discuss on a personal basis. But again, thank you for joining. You have a great day, and we will talk to you soon. Goodbye.